Okay, we have morning tea in around about half an hour from now, but we're going to talk about the Aussie dollar, what to expect, how to manage the risks if you're trading overseas and the like. I'm going to introduce you to someone who knows all about this. It's Phil Lynch, Corporate Hedging Director, APAC with Encore FX, and we're going to have a chat together. Please make him welcome. Morning. So this is where we talk about the subject matter, and we cleverly put some slides up at the same time. So it's a little dance that we're going to do. I want to first of all ask you about how you differ in this world of dealing with the Aussie dollar compared to lots of other companies, because there are lots out there.
Yeah, there are lots of us, and there's also lots of banks out there as well. So Encore FX are a specialist foreign exchange firm that help businesses manage foreign exchange risk. We do this through a number of ways. We're quite consultative in our approach, and so what that means is getting to know what our customers are actually doing and why, and making sure they're making FX decisions for the right reasons. We're also a transactional-based business as well. So what that means is that if our customers need to execute on a strategy that they're doing, then we can walk them right through that process from where to go, what is your foreign exchange exposure, what's the best way to manage it, and then actually execute the foreign exchange deals to provide that customer with protection that they need.
So tell me how, if there is a sort of a statistic on this, how exposed are a lot of folks, a lot of businesses?
It's really quite staggering how exposed a lot of businesses are. And you know, interesting, the last session was talking a bit about insolvency. It's not uncommon for us to come across businesses that you know, are running into issues because they haven't managed their foreign exchange exposure. And so for us, it's all about that risk management side of things and making sure businesses are making the right decisions for the right reasons. We quite often will see businesses are in what we'd call an unhedged position, where they simply do all of their foreign exchange transactions at spot, or on the spot market, which is just taking today's rate, whatever it might be. And in some cases, that's the right move for that business to take for whatever reason. But very rarely when we see that, have the businesses made that decision consciously or actually laid out a plan of attack as to why they'd be making that decision.
So why are most making it on spot?
Well, I think it's for a number of reasons. You know, some businesses don't have the in-house treasury expertise that some of the larger corporates would have. It's not uncommon for you know, some of the smaller businesses that are out there to not have experienced treasury people that know what they're doing. Quite often, and more often than not, it's because the board of directors have not approved an approach to foreign exchange. And so when I say approach, it means, well, you know, are you doing everything on spot, or are you doing everything that is 100% hedged, or are you taking a more strategic approach? There's a number of different approaches, and what we find is that decision is left to the CFO, to you guys in the room, and it makes it pretty challenging to make that decision, because you can be damned if you do, and you can be damned if you don't. And sometimes that's why the board like to leave that decision to somebody else, because you know, there's always the "I told you so" scenario, and I'm sure you've all probably seen the one board member that's got a strong view on currency, that's, you know, quite vocal when he's right and not so vocal when he's wrong.
Just it's interesting for any company that is dealing overseas, that has any interaction with overseas. Surely there should be some strategy in place, you would have thought, to deal with this.
Yeah, and we're going to get into some of those strategies in a bit as well. And I think a lot of people will have some sort of strategy in place. It's just a case of, is that the right strategy? Is it a strategy that they implement consistently? Is it a strategy that's been documented and communicated with the right stakeholders in the business? Because it's not just the CFO and his or her team that's you know, having to make these decisions and deal with the consequences. It's customers, it's employees, it's the frontline salespeople that might have their commissions cut if all of a sudden the products aren't so profitable. So there's a lot of different stakeholders, and yeah, too often or not, that strategy is upstairs with the CFO and not well documented or communicated.
We'll talk about the whole process in just a moment, but if you're just giving an overview of Aussie dollar at the moment, it's interesting how it's changed quite drastically in the last month or so.
Yeah, it's actually come quite a long way. Now, I do have a slideshow and I do have a clicker somewhere to change the slide. So I'm going to... Oh, there we go.
Magically appears.
So we're going to take you through a few slides today, and we're going to take you through our approach to foreign exchange. And I'm going to start with a quote from Alan Greenspan, who was the ex-chairman of the US Federal Reserve. And I think this sort of sums up reasonably well our approach to trying to pick where the foreign exchange markets will go and what everyone's approach should be. Now, we've got some really smart people at Encore FX, but I think it's fair to say that, Alan Greenspan is probably one of the most experienced people when it comes to international markets in the world. And I can't quite see the screen from either side, but I'm going to try and remember this quote from memory. And it says, despite extensive efforts on the part of analysts and traders, this is where I can't see the screen and I really would love to, no model projecting directional movements in exchange rates is significantly superior to tossing a coin. And of the thousands that try, many are successful, and so are those of coin tossing contests. And so it's a really important thing for us to remember that we're going to take you through what's happening with the Aussie dollar, but a lot of this is going to be akin to tossing a coin. So we wanted to demonstrate this to you today and demonstrate this by showing you the professional forecasts of various analysts around the world. So we've got a chart up on the screen here, and what this shows you is the Aussie dollar over the past 12 months. That's the orange worm on the left-hand side. You can see it's come down quite dramatically in the last 12 months or so. And then you've got some other lines there as well. So the yellow line is the next 12 months forecast at the maximum level. The orange-ready line at the bottom is the lowest 12-month forecast over the next 12 months. And the blue line is the median forecast there as well. Now, this is compiled by Thomson Reuters, who are the leading financial markets information provider out there. And what this shows you is just an incredible range of guesses in terms of, and I use the word guesses carelessly, but because it's a lot of analysis goes into this, but an incredible range of views on where the Aussie dollar will go. You've got ANZ and Westpac saying it'll be at 70 cents in 12 months, and you've got the Bank of America saying it could be as high as 82. And the median from Reuters is 75 cents, so quite a bit higher than where we're at the moment. Now, we spoke at this event in March as well, at the CFO series, and we actually asked the CFOs there to tell us where they thought the exchange rate was going. And they said it would be 78.13 in 12 months. So they were a bit more bullish about the Aussie dollar. And this morning, when I woke up, and what foreign exchange dealers do when they wake up is they check their phones and they check the exchange rates. It's pretty much always the first thing we do. 71.41 on the Aussie dollar this morning. So it's quite a big change in currency. When you think about that as a percentage, it's around about a 10% move from where the CFOs thought it would be from just 6 months or so ago.
So it's quite interesting. You've got the Americans thinking the Aussie dollar is going to be stronger, and you've got the conservative Australians thinking much less. So how can there be such a discrepancy? Who's seeing things totally differently?
Well, they all are, and there's so many different major players in currency. There's central banks who want exchange rates to be as stable as possible. There's governments who want to devalue their currency and increase the value of their exports. There's the big hedge funds that are out there that are investing. There's speculators, currency speculators. There's those that actually trade. There'll be a lot of businesses here that are either importing or exporting that'll be thinking, I want the dollar to go one way or the other. And so there's a whole lot of really different and conflicting views as to why the currency will go. we're going to take you through some of the themes, some of the key themes that are driving the currency lower at the moment, and talk about what that might mean in the next 12 months. But I think the interesting thing for this chart here for me is that no one's picking below 70 cents. Now, we use a thing in currency markets called implied volatility. We use that quite a lot in pricing some of our hedging structures that we offer. And what that tells us is what the expected volatility in markets will be. It's like a plus and minus figure. And at the moment, it's 9.3% as a percentage. And the general rule of thumb, the general maths behind this says that the Aussie dollar over the next 12 months will be plus or minus 9.3% from where it is now, with a 95% probability. So when you look at those expectations and look at it compared to where the dollar sits at the moment, that's about 64.70, something like that, to about 78. So that's where markets are actually pricing the Aussie dollar over the next 12 months. So, what you see here, even though this is published by the leading supplier and has got the leading banks and the leading analysts, take it with a pinch of salt, because if you want to avoid the insolvency discussion that we had 20 minutes ago, then and currency is affecting your business, then this is a big part of it.
Okay. Just on that, does what's happened in the past tell us what's about to happen in the future? Because I always think that we're living in very different times right now. So what used to work as a statistic, like you just told us, might not work in the future.
Yeah, that's right. And there's all sorts of different things that can happen in markets that will change that, and a lot of uncertainty for all sorts of reasons. So I think this chart actually, this next chart, demonstrates that quite well. This shows just how far the Aussie dollar moves each year, the Aussie against the US dollar, as a percentage from the very bottom of the range in the calendar year to the very top of the range in that calendar year. And it's measured as a percentage. So what you can see is that there's some pretty steep blue lines there, the steepest one being 54% during the GFC. So that is the range between 6004 and 9849. That was in 1 year. That was the year of the GFC, I accept that. But when you actually look at that chart and see that the average range, which is that yellow dashed line across the last 20 years, that average is 20%, well, that's quite a big challenge for businesses, and perhaps doesn't get the amount of attention it deserves, because that 20% is often impacting either the cost of goods sold or the sales revenue of a business. This year, it's not been so bad. We're at 16% so far. We've actually had a relatively quiet few years. There haven't been too many spikes above that average. Not to say that it won't change from here, because we often talk about the different ingredients when looking at currency, and I mentioned some of them before, central banks and governments. These ingredients are there at the moment. And this is probably one of my favourite charts of the current time. So this is making America great again. This is the 10-year Treasury yields chart. And so there are two parts, two lines on this chart. So one of them is the blue line that shows the Aussie dollar 10-year Treasury yield. The other line is the mustard colour there is the US dollar 10-year Treasury yield. What this shows is a couple of things. So it shows that over the last 20 years that Aussie interest rates have been higher than US interest rates for the last 20 years up until this year. And so you can see, if you zoom in closely, which I can't do unfortunately, but the Aussie dollar yield is now lower than the US dollar yield. So what that means as an investor in currency is that you won't be earning as much interest. So where you used to earn more interest on your Aussie dollars, you're not doing that anymore. You're getting better returns on the US dollar interest. The other thing this is a measure of risk, and risk is an interesting one, because when US yields are going up, it means that the US economy can be perceived as a riskier place. And remember, this is the only country in the world with a fleet of nuclear submarines that roam around the place. So this is big for US interest rates to be going up. And it's also been driving the Aussie dollar lower, because investors have been thinking, hang on, I can get a better interest rate just by holding US dollars now, and that's what's happening. So that's a demand side factor, and that's been one of the key factors, and that's because partly because the Federal Reserve are raising their rates so aggressively as well in the US, whilst the RBA is remaining very neutral. I wanted to touch on interest rates a little bit further. This page here, it just shows the difference between US interest rates and Aussie interest rates at a market level and also at a bank's published term deposit rate. Now, a couple of reasons I wanted to show you this. Well, first of all, the market rate for US dollars in 6 months is now 2.58%, whereas the market rate for Aussie dollars is 2.26%. And even a 6-year-old could figure out that if they were earning interest, they're going to want to earn a higher rate of interest. They'll take the US dollar interest rate. Yet, interestingly, banks are not offering that higher level of interest. That's not feeding through to the actual retail deposit market. So it's something that businesses need to be aware of. And if you're sitting on US dollars and thinking about this, well, then you need to be having discussions with that treasury professional, that organisation that can help you manage this. The other thing I wanted to point out about this slide is that it's very easy to see that difference and go, yeah, I want to get that extra little bit of a percentage gain there. But people don't put that hat on when it comes to currency. Currency moves 20% in a year. If that said 22% and 2%, then it would be a no-brainer. You'd be all over it doing everything you can to capture the 22%. But that's not what happens in foreign exchange markets. So that's what we're here for. That's what we want to change. I wanted to talk a bit about the elephant in the room as well, and it's not Donald Trump, it's the US debt that they have. And I saw these stats on social media the other day, and I thought it was worth repeating. So I'm just going to walk you through what these stats mean. We've got US tax revenue, that's the top one. I'm not going to read the numbers out because they're too long. That's how much the US earns. The federal budget, that's how much they spend. The new debt, that's how much they take on in a calendar year. The national debt, that's how much they already have. And
what is that? Trillion or billion? That's trillion.
That's in the trillions, yeah. And the recent budget cuts, which is in the billions. So the only way that I could see to break this down is actually by removing 8 zeros, and let's just pretend it's a household for a second. So it's like saying you earn $21,700 a year, yet you're spending $38,200 a year. You're adding $16,500 on your credit card. You've already got existing loans of $149,800, and you're cutting from the budget $385. I don't know, what's that? Three nights out in Sydney, maybe.
Wow.
It really is. So when we talk about currency markets and we talk about uncertainty, there's two things. There's the expected, there's the anticipated movement, like that 9.3% that markets are anticipating, and there's also the unanticipated stuff. And there's been a few jitters in the last couple of weeks with stock markets taking a bit of a hit. This is the sort of thing that has the capacity to trip up markets in a big way. And we talk a lot about protecting from large and unforeseen circumstances. So one thing is protecting your ongoing business from known risks. The other is looking at, well, what are some of the drastic moves here that could really trip us up?
Okay, let's talk about other events that are coming up. We've got Brexit next year.
Yeah, that's right. And so I wanted to bring this up because of the timeline, shall we say, for the next 6 months is pretty interesting. And I've pulled up a bit of a slide here on what that looks like. So there we have Theresa May. She's probably got one of the most challenging jobs in the world. I do not envy her at the moment. She's, I think it's off to Brussels to the EU Council Summit over the next couple of days to try and negotiate Brexit terms. And it actually turns out that most people are saying now that it looks like they're going to end up with no deal, which means no trade deal when they leave the EU. There's a whole lot of backup and emergency Brexit summit dates there that are there to say, well, if we can't make a deal this month, we'll do it again next month and then the following month and so on. But it's March, 29th of March next year that Britain formally leaves the EU. Now, the day after the Brexit vote, the Aussie dollar rallied against the pound, and it kept rallying for about 3 or 4 weeks. From the day before to the top, it was actually a 30% move in around about 2 weeks. And there was a bit of volatility. It came back again, and since it has drifted lower. But a 30% move. So I don't want to say to everyone out here, you should be panicking, but you should be panicking. This is a really major event coming up for anyone that's exposed to sterling. And at least with this one, we know it's coming. We don't know what the outcome will be, but...
You're saying it could be 30% either way?
Well, the uncertainty is less, shall we say, than what it was on the Brexit vote, because that really caught markets.
Yes.
Whereas
at the moment, it wouldn't be factored in?
Well, you can't factor it in because you don't know what the outcome of these discussions will be. So a no-deal exit from the EU for Britain is a really bad thing for Britain in terms of their economy and trade. It means they fall back under IMF rules for trade, and it's not very favourable. There are already businesses talking about moving massive manufacturing plants from places in England to Europe because they're not going to be able to trade with them under the normal terms. So businesses like BMW, who have car manufacturing plants in Britain, thousands of jobs gone. It could be really devastating for Britain if this were to happen. And so in that event, you can expect the sterling to weaken and the Aussie dollar will rally. If somehow they cobble together a deal that turns out to be quite good, well then this recent sort of drift lower that we've seen in the Aussie pound may very well continue.
Okay. Let's talk about some of your sort of strategies, your processes.
Yeah, so one of the things I mentioned early on was when we look at foreign exchange, we like to look at using a process rather than an opinion, rather than that opinion of the board member in the corner of the room. If it's your opinion, well, we value that a bit more, of course, but it's important to have all of the stakeholders bought into that opinion. And so in order to do this, we follow a bit of a process, and there's 5 steps in the process that we use. It's a risk management cycle, essentially. So some of you may have seen similar things before. The first step is to identify your risks. So for those of you with sterling exposure, well, you're probably thinking, what is that number? How much do I have to spend, or what's my sales revenue over the next 12 to 24 months? And start to paint a picture of how that might change. You want to set your risk management objectives in the next step. So step 2 here. And that's when you're thinking, okay, well, what am I trying to do? Is it protecting my profit margins, or is it preventing the volatility that we get? Is it creating some stability and predictability, or is it remaining competitive? And it's really good to know, well, this is why we do what we do. And why you do what you do comes in step 3. And step 3 is when you create your plan. So that's when you're thinking, well, what is my approach? Is it to do nothing? And if it is to do nothing and you've gone through your objectives and you've come out with that, well that's great. As long as it's thought through, I'm happy. But more often than not, businesses land on wanting to manage that risk and taking a more strategic approach somehow. And so I'm going to jump into the next slide here. This is something that we at Encore FX talk about a fair bit. These are your foreign exchange hedging KPIs. So when we're looking at KPIs, they're often, target driven, but in this case, what we want to understand is what is the total amount hedged for a business at any one time. So in this scenario here, we've got a business that's got $4.15 million US of hedged positions, which means they have FX contracts in place, guaranteeing a rate that is, protecting them from future movements. Then you've got a hedge ratio that is 69.2% in this case. So what that means is of their forecast exposure, that 4.15 million equates to 69.2% coverage. So of all of their exposure, they're covered for 69% of it. They've got an average hedge rate there of 8,009. So please forgive me for using a rate like that today for any importers. I know it might hurt a little, given where we're at, but this was teed up in March, this slide, so it was done a little bit earlier. The other thing we talk about there is your secured FX gains. So what have you secured versus your budget rate? A really important part of any foreign exchange hedging and execution is actually going, right, well, where's my budget rate at, and can I get better than that budget rate? And so in this case, I think the budget rate in use was 76 cents, and so over and above that budget rate of 76 with the 8009 rate secured, they'd actually secured $173,000 of gains. And these can start to paint some really important numbers for businesses, because they start to understand then, well, you know, I've got some money to play with here. The dollar's down a bit, so it might be a different discussion now. But that number there, if you can understand what that is and why you've got it, then maybe that's an extra employee. Maybe that's a bit of buffer for something else, for a new project or something, or a bit of buffer for the current scenario where the dollar's come off a long way. The other thing we wanted to do today was talk about some of the different types of foreign exchange contracts that you can take out. So this is the fourth step of the foreign exchange hedging cycle, and this is where the rubber hits the road for Encore FX. So we like to get right into the nuts and bolts, the strategy side, why you're doing what you're doing, but our business model is really an execution business model, which means we book the actual transactions for you. And there's three common types of hedging transactions that you can take. The first one is a fixed forward exchange contract, sometimes known as a forward contract, a forward, or an FEC. And this gives you a fixed amount at a fixed rate at a fixed date, and it gives you certainty. So hopefully for anyone in the room that has FX exposure, you've come across this type of product before. It's the most common one that's out there, and it's good because it gives you certainty, but it does lack a degree of flexibility. The next product is a vanilla option. It's a bit like the Rolls-Royce of foreign exchange hedging. It's expensive. You have to pay a premium for it. It gives you a worst case rate, but after you've paid that premium, you have no obligation to take up that contract. So what that means for an importer or an exporter is that you can walk away from that contract and deal at the more favourable rate if the rate moves favourably. But it does come at a premium. So where we see the most interest from businesses in Australia is through structured options. There's a huge array of structured options, so it's important you can trust who you're dealing with when you're talking about these. But these give you a combination between certainty, flexibility, and balance. And I wanted to run through a scenario that we did with a real exporter earlier in the year. So this was a scenario where a business had come to us. It was about June of this year, and some of the numbers are rounded off here to paint the picture, but the exporter had won a $4 million project in June with quarterly payments of $1 million across the life of the project. The spot rate at the trade date was 76 cents, and this particular exporter had budgeted at 80 cents. So they had a bit of breathing space here. They had some room to move. So their typical process was just to lock in a fixed forward exchange contract, and the fixed FEC rate available was 76 cents. So as an exporter, this business is thinking, okay, well, I can lock in now a 4-cent gain over $1 million. That's pretty good, right? They've got the ability to do that. That gives them some certainty. But what we presented in this scenario was a range of other possible alternatives, and particularly given the move in the Aussie dollar, which was heading lower, and one of them was a collar contract. Now, this is my attempt at demonstrating how this collar contract works on a chart. So I'm going to explain this, and some of you may have seen this before. This is actually one of the more basic instruments, and so my goal today is to demystify this for you all. So there's a couple of different lines here. So first of all, the blue line, the one that goes up and down, is the Aussie-US exchange rate, and you can see that the trade date I've highlighted there was around about June, when the Aussie dollar was trading around 76 cents. So instead of booking a forward rate of 76 cents, what we've booked in this scenario is a collar option, a collar structured option, and this gives a worst case rate of 78 cents and a best case rate of 74 cents. And what that does is it allows the exporter to A, secure a worst case rate to be protected from adverse currency movements. It is at 78, so it's a little worse than the forward, but they're still ahead of their budgeted rate. But it also gives them the flexibility to deal down to a best case rate of 74. So instead of giving them a fixed trading range, we've simply booked in here a contract that allows them some flexibility whilst maintaining protection. And I like this one in particular because, you know, it's the old adage of let the trend be your friend. The Aussie dollar was falling, US interest rates were rising. It continued to fall, and as a result, the first quarterly payment was done at the best case rate of 74 rather than at a fixed contract rate, which would have been 76. And so it actually gives that exporter a pretty significant advantage, and so they've been able to capture some of the favourable exchange rate movements. So this is one example of a type of product that we can offer our customers and that we can explain in a pretty basic way, and it can make your decisions harder sometimes, but it's absolutely something that you should be considering when making FX decisions. Another scenario, and I'll try and race through this one a little faster. We've got an importer scenario here as well. An importer who is a wholesaler in US dollars. They're bringing in around about $1 million of product per month. They actually have a strategic hedging policy where they book a minimum of 50 to 100% of their exposure out for a 6-month period, which means of the $6 million, they should be hedged at a minimum of $3 million as per their policy. So they start by doing the 50% by using fixed forward exchange contracts. That gives them the baseline that they need. But between that 50 to 100%, the second $3 million over the next 6 months, the Treasury team is empowered to actually take some more sophisticated products. And there's a huge array of these, so I'm just showing you one today, and it won't work for everyone here. But in this case, we're going to compare it to a product that had an exchange rate of 71.50. That was basically your status quo, fixing in a rate of 71.50. The product I've chosen here is what we call a ratio forward, a 2-to-1 ratio forward. So in this case here, we've got a 6-month time frame there. We've got an amount of $250,000 that the importer is protecting. What you'll see with the exchange rate is that it's actually been enhanced, so that rate is now up to 72.50. So it's quite a significant improvement on the rate there. But there's also a leveraged amount there of $500,000. Now, this is all probably sounding a little bit complicated for some that might not have seen this before. So our job at Encore FX is to speak in plain English to our customers when we're talking about this stuff. So there are literally only 2 possible outcomes if you take this product with us. The first one is that if the spot rate finishes below the enhanced rate of 72.50, then you have the right to buy $250,000 US at 72.50. So you've actually outperformed the worst case scenario on the forward, which was 71.50. So it's a reasonably good solution there. The other outcome here is that if the spot rate at the expiry date finishes above the enhanced rate of 72.50, then you will be obligated to trade the leveraged amount of $500,000 US at 72.50. So it adds a slight degree of sophistication or complexity, but I think the benefit is pretty clear in that you're able to achieve a rate 72.50, significantly enhanced over the typical forward exchange contract rate.
Just a couple of minutes left, so let's just talk about the KPIs, how you kind of look at how it's all going.
Yeah, so when we talk about the KPIs, we want to wrap all of this sort of stuff into your strategy. So if your strategy is to hedge 100%, then we would try and hold you to that as best we can. If it's to hedge 50%, we'll try and hold you to that as best we can. And where we fit in is when we're looking at products like this, this ratio forward here, this structured option. We want to make sure that that fits within your strategy and your KPIs, and make sure that you understand that. So the KPIs was the slide that I went through a little bit earlier. So it's things like hedge ratios, your total amount hedged. And so if you are wondering what your KPIs are and you don't know, well, then that's where someone like Encore FX can fit in. And I got one last quote for the day since we're wrapping up. This was thanks to one of my colleagues in our Sydney office who shared this around. It's only when the tide goes out that you can see who's been swimming naked. And the Aussie dollar fall recently has, shall we say, exposed quite a few people. So if you're wondering about swimming naked, our advice is to not swim naked. Certainly not when it comes to currency markets. So please do think about that. And
we're going to do a competition?
Yeah, that's right.
He's a very wise man, is Warren. I like that. Let's end with the competition. This is where they get all the information. They take 180 CFOs and they put this into the system. This is how they gauge where the exchange rate is going. What is it going to be today?
That's right. So I've told you a little bit about what's driving the currency, and I've told you that no one really has any idea and it could go up or down, and that you should manage your risk. But we still want to collect all of your views, so please come and see us afterwards, or follow the link on your phone and go to our website, encorefx.com.au/CFO series. Put your rate in for 2 weeks. We also ask for a 12-month estimate, and that's what we also publish to this group afterwards in our communications. And you go in to win a magnum of Moe. So
it's always interesting when we go around the country with this one, the different opinions that are expressed from the different cities. So we'll get that in today. Good. Phil, thank you very much indeed. Very interesting. Phil Lynch, ladies and gentlemen. Okay, we're on time for a morning tea. We're going to be back here in 40 minutes or so, so if you want to go and enjoy a little break, please do. We'll see you soon.